All right, let's jump right into it. We're going to tackle one of the biggest, most anxiety-inducing questions in all of personal finance. You know the one. It's the question that has you staring at the ceiling at 2 a.m., crunching numbers on a mental calculator, trying to figure out some impossibly huge, almost mythical amount of money.
Yep, that's the one. How much money do I need to retire? And with a date like 2026 staring us in the face, that question feels a lot more urgent, doesn't it? You're probably thinking of a number right now. Is it $1 million? 2 million? 5? We've all been trained to think that the finish line is just this giant pile of cash.
But here's a thought. What if focusing on that one big number is not only super stressful, but it's also the completely wrong way to think about the problem? What if the key to actually solving this puzzle is to ask a better question? Well, that's exactly what we're going to explore in this deep dive.
So here's our roadmap for today. First, we're going to take apart that classic $1 million question. Then we'll completely redefine what the finish line even looks like. After that, I'm going to introduce you to a really powerful framework called the 4 pillars. We'll get into how to make money no matter what the market is doing, how to actually manage your risk, and finally, how to make that critical shift from just being a hopeful passenger to being the actual pilot of your own financial future. Okay, let's get into section 1. Before we can build something new and strong, we've got to understand why the foundation of the old plan is, well, kind of shaky. And it really all boils down to 2 totally different ways of looking at your money. On one side, you have capital gain. This is the classic buy low, sell high model that your 401k is built on. The entire goal was to grow this massive pile of money, your net worth, that you hope will be big enough to sell off bits and pieces of later. But on the other side, you've got cash flow. Think about Monopoly for a second. You don't win the game by just flipping properties, right? No, you win by putting those little greenhouses and red hotels on them so you can collect rent. That rent, that's cash flow. It's a steady stream of income that your assets produce for you. This idea from Robert Kiyosaki really nails the difference in mindset. One person says, "My house is my biggest asset," because they're hoping its value goes up over time. That's a capital gain mindset. The other person says, "My house is a liability," because every single month it takes money out of your pocket for the mortgage, taxes, and upkeep. It doesn't generate cash flow. An asset puts money in your pocket. A liability takes it out. Understanding that one little distinction changes everything. So why is banking everything on capital gains so risky? Let me give you a real-world horror story. Picture this. It's 1985 in Japan. A 50-year-old does exactly what they're told. They invest in a diversified portfolio for the long haul. By 1989, the market is on fire. It's gone up 4 times over. The plan looks like pure genius. But then the bubble bursts. Fast forward 20 years to 2005. Our investor is now 70 years old and needs that money to live. But the market? It's down over 60% from its peak. Their retirement is in shambles. Even by 2015, a full 30 years later, the market still hadn't gotten back to its 1989 high. Their entire buy, hold, and hope strategy was a total disaster. So, if chasing a giant pile of money is a broken strategy, what's the alternative? This brings us to section 2. It's time to stop chasing a number and start aiming for a state of being. We need to completely redefine the finish line. And here it is. The new goal is called financial independence. The definition is so simple, it's beautiful. It's the point where the passive income, the cash flow coming from your assets, is greater than your monthly bills. That's it. That is the entire game. Just look at how clear this makes the math. Let's say your life costs $5,000 a month. The very second your assets, your investments, are kicking off $5,001 a month without you having to work, you've won. You are financially independent. The race is over. And this is the real game changer. We're completely separating the idea of retirement from your age. It's not about turning 65 anymore. It's about building a financial machine that pays your bills. The goal is to get your cash flow to cross that finish line of your expenses. And it doesn't matter if you're 50, 40, or even 30 when it happens. It's your financial system's performance, not the calendar, that sets you free. Okay, that all sounds amazing, but how do you actually build that machine? Well, that brings us right to section 3, the 4 pillars framework. I want you to think of this like the actual architectural blueprint for building a portfolio that is designed from the ground up to be strong, stable, and to produce income. See, these 4 pillars all work together to support every single investment you make. You start with Pillar 1, fundamental analysis, to make sure you're investing in something solid. Then you use Pillar 2, technical analysis, to read the market's mood and figure out when to get in.
From there, you use Pillar 3 cash flow strategies to make sure you get paid. And finally, and this is so important, you protect the whole thing with Pillar 4 risk management. It's a complete system that gives you a plan from start to finish. Now, let's zoom in on that third pillar, cash flow, because this is where the pros really separate themselves from the amateurs. Most investors are basically one-trick ponies. Section 4 is all about learning how to make money in any environment.
A lot of people forget that the market doesn't just go up. In fact, it only trends up about 40% of the time. Another 40% of the time, it's going down. And the other 20%, it's just kind of stuck, moving sideways. The average investor with a 401k is betting their entire future on that first 40% slice. A pro knows how to find opportunities in all three market directions.
So we all get going long. You buy stock at $20, sell it at 40, you make $20. Easy. But what about making money when the market is tanking? That's called going short, and it's really not as scary as it sounds. Seriously, look at the profit. It's identical. The only thing that changes is the order you do things in. Instead of buy then sell, you sell then buy. You're probably thinking, how can I sell something I don't own? Simple. You borrow the stock from your broker, kind of like borrowing a cup of sugar from your neighbor. You sell it at the high price, wait for it to drop, buy it back at the low price, return the share to your broker, and you pocket the difference. It's an incredible tool.
So how can you tell when a stock might be about to head down? Well, technical analysis isn't a crystal ball, but it does let you read the psychology of the market. Let's walk through a classic pattern. They call it the kiss goodbye. So first, you've got a stock in a nice, healthy uptrend, but then it hits a price ceiling and pulls back. It tries to rally again, but fails at that same exact price point. That's a double top, and it's a huge warning sign. The market is basically shouting, nope, it's not worth more than this. Then the price crashes through its old floor. And here's the final clue. The price often tries one last time to rally back up to that old floor, kind of kisses it goodbye, and gets rejected. That kiss confirms the sellers are now in control. It's a story playing out right on the chart.
And that leads us to maybe the most important pillar of them all, Section 5, the art of managing risk. See, the goal of a professional investor isn't to avoid risk. You can't. The goal is to understand it, measure it, and most importantly, control it.
Now, there are really two kinds of risk you need to know about. There's non-systemic risk, which is when one specific company gets into trouble. You can manage that pretty well with diversification. But then there's systemic risk. That's when the entire system has a meltdown, like in 2008 or that Japanese crisis we talked about. When that happens, diversification is useless because all your stocks are going down together on the same sinking ship. And your standard 401k, it is almost completely exposed to that much more dangerous systemic risk.
Let me put it this way. We all accept that houses can burn down. It's a known risk. So what do we all do? We buy homeowners insurance. It's just common sense, right? Well, guess what? Markets can burn to the ground too. So why on earth wouldn't you have some kind of insurance on your portfolio? That's all risk management is. It's not crazy speculation. It's financial fire insurance. It's the responsible thing to do.
This is what it looks like to be a pro. Amateurs jump into investments based on a hot tip or a gut feeling. Professionals operate from a written plan. Before they ever put a dollar at risk, they know exactly why they're getting in, they know their profit target, and they know their stop loss. That's their eject button. It's the price where they say, I was wrong and I'm getting out to protect my money. Look here, the potential reward is 3 times bigger than the potential risk. Every move is calculated. It's business, not a casino trip. Okay, let's land the plane here in our final section. We've covered a lot, but it all comes down to a simple shift in your identity. We're moving from a passive, hopeful mindset to an active, empowered one. We're going from hopeful to builder. So which one are you? On the left, you've got the hopeful investor. They dump money in a 401k, close their eyes, and just pray the market goes up for 30 years. They have zero control. They are just a passenger on a plane getting tossed around by turbulence. But on the right, you have the builder. This is the pilot. This person uses the 4 pillars to read the weather, to manage the controls, and to actively build a portfolio that generates cash flow. They aren't just along for the ride. They are flying the plane, able to navigate storms and land safely at their destination. So I'm going to leave you with this thought. When you use this new framework, that original question, how much do I need to retire in 2026, it totally transforms. It's not about some giant, scary number anymore. The real question, the better question, is how much cash flow do I need to build by 2026 to cover my monthly expenses? And suddenly, the goal isn't this abstract pile of money. It's a concrete, measurable, and achievable income stream.
So take a hard look at your own strategy. Are you just piling up bricks and hoping the wall is high enough? Or are you an architect, building a machine designed to support you for the rest of your life? The control is all yours.